Hi, price is what we're going to talk about today. First, let's relate price to value. Value, as you remember, is the net worth of something. It's the judgment of what we get versus what we give up. And previously, we talked about three different types of benefits: functional benefits, psychosocial benefits, experiential benefits. And there's three types of costs: financial, or things of value, time, and effort. So we can see right now that price normally plays the role of the financial cost for a buyer. So when we look at this value equation, so to speak, what are the different ways that a company who usually is looking to maximize the money that they get, the financial reward they get from the customer, how can they do that? So there are two ways. One, if we increase the benefits that we offer customers, we can then increase the price, which increases their cost, but still maintains the same amount of value. The other thing that marketers can do is reduce the other types of costs that the buyer has. In other words, make it easier, save them time, and therefore, theoretically, they'll be more likely to pay more money, give up financial resources to acquire the product. So the first thing we're going to look at is, how does a marketer set a price? To understand that, we're going to look at 5 factors that influence a marketer's ability to set a price. So the first factor has to do with the maximum price a marketer could charge. What sets that maximum price? Well, in theory, the idea is the benefits of the brand. If the cost of the brand to the consumer or the buyer is greater than the benefits, then they're not going to buy. So we can think of the maximum or the ceiling price as set by the benefits. If we need to be able to charge a higher price, one way to do that is to increase the benefits that we offer. In most cases, a buyer isn't going to purchase a brand if they feel the benefits are outweighed by the price. But there are situations where that's not always true. For example, when the price of gasoline goes up, it's been as high as $4 a gallon in recent years, we still buy a lot of gasoline. We really don't change our driving habits. And if all the different cell phone companies and service providers decided to raise their rates, I don't think many of us would discontinue our cell phone service. So there are times when we can get buyers to pay more than what the benefits suggest that the price should be. Why isn't that a good strategy? Well, one, it makes customers dissatisfied and resentful. So when there are alternatives in the marketplace, they're going to switch as quickly as possible. Setting really high prices also attracts competition into the marketplace. And finally, if the prices are onerous, that unfair, hurt competition, then the government is going to intervene. Well, if the benefits normally set the maximum price you can charge, your costs at the minimum. You're in business to make a profit, to survive, to grow. So normally, companies have to price their brands above their costs. There are times, though, when companies sell their brands for below their costs. When they have excess inventory, especially if the product is perishable. They need to move the product through the supply chain by giving discounts and using sales promotion and rebates to channel members. Loss leaders. Think of Black Friday. Companies sell some products below their cost or for no profit at all in order to attract people to their website or to their store where they'll spend other money. To build relationships. Remember, relationship marketing says that, hey, we should consider the lifetime value of the customer. And therefore, it's okay to invest in the customer in the beginning of the relationship, even though we don't make a profit. Because over the long haul, the lifetime of the customer will make up that loss and enjoy nice profits. The government and the laws and regulations that come from the government are also important. So between the maximum or the ceiling and the floor or the minimum, the government often has an impact on the price that we set. The government's main concern is with creating an environment of fair competition, that it's a level playing field for all the companies. So there are three areas they look at. The first is price discrimination. All customers should get the same pricing. Price fixing. Companies can't collude, get together, and decide to all set similar prices. The competition should include differences in price. And finally, predatory pricing and unfair trade practices. Companies should not set prices that are so low that they drive out their competition. It's okay to set a low price if you're making profit, if you're selling your product at a reasonable price. But if you're setting your price so low that none of your competitors have a chance and you're foregoing profit in order to drive them out of business, then the government will step in and stop you. And of course, your competitors influence your ability to set a particular price. And so when we look at your competitors, strong competitors who have brands out there that offer high levels of value, they often force your pricing down. So in order to meet or exceed the value they're offering, you need to lower the costs for the buyer. On the other hand, if you have weak competitors, you should be able to charge more. You should be able to raise your price, because even though your price is much higher, you still have more value than your competitors. The last factor is often called corporate objectives. In other words, price is part of your 4Ps, your marketing mix. It's part of your overall marketing strategy. So the question is, what are you trying to accomplish as you set a price? How can price play an important role in that? So one type of objective is profit objectives, which may take the form of maximizing profits, trying to hit a certain target level of profit, or maximizing return on investment. The benefit of these approaches is that you're going to be profitable if you reach your sales goals. The risk is whatever price that you need to set in order to be profitable, that may not be realistic. Do you think the buyer really cares about how much profit that you make? A skim pricing strategy is the most commonly used profit objective. Skim pricing usually occurs during the early parts of the product lifecycle, during introduction and growth. The idea is that the company sets relatively high prices. Very common with new electronics and most new products. Companies set high prices. You get to recoup your investment faster because you're going to make more profit. You have a legal monopoly if you're the first company or the only company in the marketplace. So you really don't have any competition. The disadvantage to skim pricing is that one, that it does lead to less sales, and two, it can often attract competition. As your competitors look at the new market that you have entered, and they see that you have high prices and presumably pretty high profit levels, that makes it attractive to them, and they're more likely to enter the market. The other issue you have is, okay, so you're the first one in the marketplace. You set a high price for your new product. It's doing really well, and now your competitors come in the marketplace. The typical strategy for your competitors is to make a similar type of product but price it below your high price, and just enough so that difference is important to consumers. So what happens is you start to lose market share to the competitors as they come in with similar products priced at a little bit lower and offering to many people more value. How do you handle that? Well, one problem is if you just lower the price of your existing product, you're going to lose profit, and also you're sending out a message to the marketplace that you can't sustain that higher price because your competitors are just as good and that they're taking market share away from you. The preferred way of handling it is to use a modified skim pricing plan or strategy. The idea is you're in first in the marketplace with the first brand. It kind of sets the standard for everybody. Your competitors come in and underprice you by enough to make a difference to take away some market share. So what you do is you come out with a new model or a new brand. Leave your existing original product where it is, or perhaps even improve it and raise the price to position it as the leader, but then launch a new model that is comparable to the competitors, and you probably take one or two or three features of the product out. So it's a good competitive brand. It has your strong brand name. It doesn't do everything that your best model does. And so as the market develops and competitors offer lower and lower priced brands in order to create more value, you can continue to launch new models with reduced features and quality to meet those competitors that you have. Another objective is volume or sales or revenue objectives. You try to maximize your sales revenue and market share. Get more sales than everybody else. This is often called a penetration strategy. Again, it's pretty common in the early stages of the product life cycle. Companies use low prices to create greater value to attract new buyers and encourage repeat sales of their brand. It has some nice advantages. It creates high value, enables you to build up a loyal customer base. It discourages competition from entering the market because you're not making a lot of profit, and they would have to have a higher price or somehow have lower costs. It also enables you to gain lower costs more quickly through the experience curve, through economies of scale. So the more that you sell, the more you make. The more you make, the better you get at making them, and the more you can lower your costs. So either buying better because you're buying in greater volume, or because of the learning curve, you get more efficient at making them. So over time, your costs will drop rather quickly, and then your profitability will go up. There are some disadvantages. You're giving up profit today. You need to recapture it. The sacrifice you're making today in profit may not be available down the road. As we talked about earlier, product life cycles change. Technology changes. New competitors enter the marketplace. So you may not have that opportunity to make up for lost profit. And finally, in many markets, for many brands, price is not the most important factor. So when competitors come in with new features or different features, better features than what you have, you may not be able to match those features, and the price won't be important at all. The communication objective is about setting a price in order to influence the buyer's perception about the brand. Buyers often use price as a way to get information or to judge a brand. Most commonly, buyers often feel that in many cases there's a relationship between price and quality. Higher priced brands will often be perceived as having higher quality. Lower priced brands will often be perceived as having less quality. In other words, buyers infer quality from the price of the brand. When is this most likely to happen? First, the buyer has to believe that there are real differences between the brands, that all the brands aren't the same. Secondly, usually the buyer doesn't know very much about the brand. They have little brand knowledge or product category expertise. And in the same vein, this can occur when it's difficult to judge the differences between the brands. Things like jewelry, universities, wine, yachts, mattresses, they can be difficult to compare. So we often assume that a more expensive bottle of wine is better. A college that charges more tuition is better. Mattresses that are more expensive are better. So oftentimes companies will set their prices high to gain that perception because it adds value to their overall brand. The last objective we're going to talk about is competition. In other words, you set your price relative to your competition. Often this is done to maintain positioning. Sprint, because of perceived inferior quality, has to price itself below Verizon and AT&T in order to create value. Verizon, on the other hand, will always price itself above Sprint because they claim they have better quality. Companies will often price match their competitors. One reason for doing price matching, such as Walmart and a bunch of different retailers will match prices, is because they want to eliminate price as a factor in customer decisions. If you know that if you go to Home Depot, you're going to get low prices. You may not get low prices on everything, but if you know that if you buy something and you see it for less someplace else, that they will match it, it relieves that dissonance. So you're more likely to go to Home Depot and feel good about the pricing and probably never even do any price matching. Matching prices also signals to your competitors that you will match any of their price decreases. For example, T-Mobile in the past often attacks AT&T by offering better value and lower prices. Usually AT&T responds almost immediately and basically matches them for blow in terms of pricing and value. This is really important to AT&T because it's very easy for AT&T customers to take their phone and go to T-Mobile because they use the same cell technology. So for AT&T, it's a way to signal that, hey, if you're going to mess with us, we're going to fight back and we're going to be really aggressive. Let's take a look at these two sweatshirts. The one on the left is made out of cotton or cotton polyester. The one on the right is made out of the same material. It's a little bigger, uses a bit more material, but it's still made out of cotton and polyester, made the same way. It does have a print on it, 2 French bulldogs, and some other words in French. The other one's plain. The one on the right sells for $1,800 at Neiman Marcus. The one on the left sells for $7. It's made by Hanes. Why is there such a big price difference? How can Neiman Marcus get $1,800? The manufacturer of the one on the right is Gucci. So you know Neiman Marcus is paying a lot of money to be able to retail that. How come? Well, it starts to make more sense when we think about pricing from the perspective of the buyer. The buyer really doesn't care how much it costs the marketer or the retailer for the product. They only care about what they have to pay relative to the benefits. So if you add more benefits, you can increase the price. If you don't have a lot of benefits, you can increase the price. So really, in my opinion, when setting a price, the best way to go about it is to find out what your product is worth to people. How much would they be willing to pay? Sometimes they don't know that. You have to figure that out based upon the other types of brands or products that they use. But you'll know pretty shortly whether your pricing is correct. But remember, your customer doesn't care whether you have a profit objective or whether you're trying to corner the market. They only care about what they get versus what they give up. So all pricing starts with that. Another way to approach pricing that's different from those classic objectives that we went through is yield management. Yield management is a system where different prices are charged depending upon the demand and availability of the brand. And it's done in a way to try to maximize the profits for the company. A really good example of this is airlines. They use yield management pricing. So when you think about it, a flight, there's a lot of fixed costs. You have to pay the two pilots. You have to pay the attendants. You're going to use pretty much the same amount of fuel, whether it's a full plane or it's empty. You have to pay whatever airport fees that you have. So there's relatively high fixed costs. The costs that vary by the number of passengers, maybe it's in the number of snacks they eat. All right, so it's not a big percentage. So what is important to the airlines? They want to make sure that on every flight they at least cover their costs. They at least break even. So what they do is when the flights are first available for purchase, they set a really low price. That's why we all buy our tickets in advance, because the prices are low. They want to make sure that they get enough people on the plane that they can cover their costs. As the sales increase and approach break even, they start to raise their prices. Now they use some sophisticated models and statistics, and they have a whole bunch of historical data to look at, so they're pretty good at predicting when they're going to get enough passengers to cover their costs, when they're going to break even. So when they reach that point, they begin increasing the prices. So that's why if you wait and you buy a ticket right before the flight, it's really expensive. Because they're saying, look, we've sold 60%, 70, 80, 90% of our seats. There's not many available. They're in demand. So we're going to charge more for them. Now, at the very end, before the flight takes off, if they have any empty seats, they're available at really low prices. Not so much that you can buy them right at the gate, but if you buy a standby ticket for an airline, which means that you get to go on a flight if there's any unsold seats. But if the flight is full, you can't go on the flight. The standby ticket is the one that people get for a low price. And that way, they fill all their seats. And even though they may not make much profit or any profit, at least they don't have an empty seat. At least they're collecting some money. Hotels, events, they also do the same type of pricing. So if you're going to book in advance, you get a lower price often. If it's late at night and you go to a hotel or motel and there's competition around, be sure to ask for a lower price. You're likely to get it. Why? Well, if it's 10 o'clock at night, there's probably not a lot of other potential customers walking in the door. If you leave to go to another hotel, that hotel where you're at right now, they don't collect any money. So even if they don't make much profit or any profit, at least they're collecting some money, and some money is better than no money. So yield management pricing, I would assume that in the future we'll see more and more applications of it. But usually it's most effective when there are high fixed costs involved and limited availability and such things. So that includes services, events, and other types of brands like that. The last topic is going to be elasticity, or what some people would call the elasticity of demand with respect to price. So before we talk about it, let's just get a better understanding of elasticity in general. First of all, we need to understand what a demand curve is. That's the graph that you see on the screen. The demand curve is a plot of the relationship between the price of a brand and sales. So it captures that relationship. So in the plot we have right on the screen, you can see that when the price is $5, there's not that many demanded, only 10. As the price drops, going down vertically, demand increases. So at $5, people only buy 10. At $3, people buy somewhere between 20 and 30, closer to 30. And at $1, people buy over 50 of them. So that's what a demand curve is. It estimates the sales at different price levels. Not all demand curves are downward sloping. Some products that involve status, prestige, snob appeal actually will be in more demand the more expensive they are, because the more expensive they are, the more prestige there is. But for many or most brands and goods, normally there's a downward sloping demand curve, so that to some degree, the lower the price, the more quantity demanded. So, to sum it up, elasticity of demand with respect to price is really a measure of price sensitivity. It measures how much more or how much less do people buy when the prices change. How much more do they buy when the price drops? How much less do they buy when the price goes up? So, when demand is said to be elastic with respect to price, it means that it goes up and down a lot with changes in price. In other words, buyers are very price sensitive. Now, we can think about this with respect to total revenue. So total revenue is the total amount of the sales dollars that a company collects when people buy their product. It's equal to the number of units sold times the selling price. So when demand is elastic and the price goes down, total revenue increases. So let's look at the chart on the right to understand that. So we can see that the highest price listed there is $1 on the vertical axis there. And there's a dotted blue line that intersects the demand curve, that straight downward sloping line that's relatively flat, where the quantity is 3. So when the price is $1, people buy 3. Whether it's 3, 30, 3 million, 3 billion of them, it doesn't matter. Total revenue would be 3 times 1. Let's call it $3. So now when the price drops to 75 cents, People now buy 9 of them. So if we take 75 cents times 9 units, that's equal to $6.75. So, which is more than the $3 the company got when they priced it at $1. So you can see also just visually the box made by the 75 cents and the 9 units is much bigger than the box or the total revenue when made by $1 and 3 units. So when demand is elastic, if you can lower your price, people are going to buy so much more that your total revenue will go up, even though your price per unit went down. People are very sensitive. So if you can lower your price, it's often to your advantage, especially if by selling more you make more and you lower your costs. You can make up for that difference with lower costs, so it becomes very profitable. Now, on the other hand, if you raised your price from 75 cents to $1, you saw a big drop in total revenue. You went from $6.75 to $3 just by raising it a quarter or 25%. So when demand is elastic, right, you have to be very careful about passing on price increases or raising your prices, because consumers or buyers will switch to other brands or substitutes very quickly because they're so sensitive to price. When do brands tend to be elastic or have elastic demand? When they're relatively commodities, when they're all viewed as being about the same, and there's widely available substitutes. We can switch from one brand or one type of product to another. Demand is said to be inelastic. It's not like a rubber band, okay? When people are not sensitive to price. In other words, if the price goes up, they still buy about the same amount. All right? And if the price goes down, they really don't buy anymore. And when it's inelastic, the reverse is true, right? So when we have a low price, let's look at that graph again. Let's start with the 50 cents, the bottom price with the blue dotted line. So when the company has a price of 50 cents, they sell 5. So 50 cents times 5, well, that's total revenue of $2.50. If they triple their price to $1.50, right, they still sell 3. Yeah, sales went down, but they only went down by 2. And now if you look at that, $1.50 times 3 units is $4.50. That's their total revenue, which is considerably larger than the $2.50 they had with a lower price. So, what's the general rule of thumb? When pricing is inelastic, that demand doesn't really change with increases in price, you should raise your price. Raise it until it begins to become elastic, where people care enough. But otherwise, raise your price. Keep the profit. Your product has a lot of value or is important, and people are going to continue to buy it. On the other hand, remember, lowering your price isn't likely to give you the bump up in sales you want. As a matter of fact, your total revenue may go down. So, what makes a brand inelastic? First of all, if it's viewed as a necessity or there's very few substitutes because it's unique. Many times, if the cost of the item is relatively low compared to a person's budget or what they normally spend, they're not that sensitive. If you go to the grocery store and you spend $200, every 2 weeks on groceries for your family, and the price of butter goes up by 25 cents, you're not going to stop buying butter, all right? Because 25 cents isn't very much. Now, if you're the company Land O'Lakes that makes the butter, and every stick of butter is now you get an extra 25 cents, and you sell 200 million sticks of butter a week, that's a significant price increase for you. Brands often have inelastic demand because they have so much value, which means they're really being underpriced or priced incorrectly because they have such value that even if the price goes up, people are still going to buy them. Think about your favorite brands. If your favorite brands were to have a price increase, how much higher would it go before you'd switch to a second or third brand? And then finally, many times luxury items, as we talked before, increases in pricing increases perceived benefits such as status and prestige. So price increases can actually increase quantity demanded.